Earlier this month in June, a lot of people, including myself, were very much caught off guard when the Bank of Canada raised their overnight lending rate by 25 basis points. And it looks like they're going to do the same thing in July by all accounts. And I think a lot of the reasons why I was surprised and a lot of the reasons why I have consternation about them potentially doing this again in July as well, it just doesn't make sense. And a lot of people are pointing to the fact that real estate prices, despite all of this increase in interest rates, are continuing to go up simultaneously, almost to the point now where we are at peak real estate prices here in Toronto prior to when interest rates were at 2%. And that somehow is giving the Bank of Canada a lot of leeway to continue to raise rates. But I think the most important thing is fundamentally to understand what the Bank of Canada's mandate is. And that is, number one, to bring inflation under control and keep it at around 2%. And to make sure that employment remains strong. That is it. They are not supposed to be thinking about anything other than that. And they are certainly not supposed to be politicized by the powers that be. And I think there's a lot of mission creep that's coming into the Bank of Canada. And I don't think what they're doing right now is in the best interest of Canadians or the economy. You know, if you look at every single recession that has occurred, it's been driven by policy and it's been driven by policy error. And oftentimes what will happen is that a bank, like a central bank like the Bank of Canada, will get over its skis and they will raise rates too much for the economy, and eventually it will tighten so much that it will push it into a recession. And I think we're very much on the cusp of that here right now. And I'm not an economist, but I do think logically, and I do own a business, and I'm very much involved in real estate. And I don't think you have to be an economist or a genius or employed by the Bank of Canada to have real concern about what they're doing. And from my lens, they need to stop, they need to continue this pause, and they need to let things work through the system. I'm Ralph Fox, and I am the broker of record and co-founder of Marin Associates. And we are a boutique residential real estate brokerage that works and plays in central and downtown Toronto. The purpose of this playlist is to look at and discuss long-term macro trends that could affect or will have an impact on real estate prices here in Toronto. If you find this information interesting, please be sure to hit that subscribe button down below. And if you have any questions or comments, we'd absolutely love to hear from you. Okay, well, let's take a look at the numbers that came out earlier this week. So what came out was in the month of May, the Consumer Price Index, CPI, rose by 3.4%. And this is really relevant because if you look at the month of April, it was up 4.4%. So we've seen a full percentage point drop month over month in inflation. Now, we would think that this is a really good thing. But what's even more interesting here is if you look at the inflation numbers and you take out mortgage costs, we're sitting at about 2.5%, which is almost within range of the Bank of Canada's mandate of 2%. Now, if you look at the interest cost index in the actual CPI, that rose by close to 30%. I think it came out at like 29.9%. So it's really relevant to understand this because this is something that would be expected when you raise interest rates 400 plus basis points in a very relative short time over the course of the year. Of course, mortgage costs are going to go up. But take that out of the equation, which we should be done, and we're sitting much closer to 2.5%. Now, there was a really good article in the Financial Post, I'm going to butcher his name, by Ted Rechthafen, and he was talking about this very issue, and he was passionately arguing that the Bank of Canada needs to stop raising interest rates and they need to stop raising interest rates right now. And I couldn't agree more. And in the article, he makes the analogy that when it comes to raising mortgage interest costs, a Bank of Canada interest rate hike is like suggesting that someone with high blood sugar should eat a sugar cube to bring down their blood sugar level. If you raise interest rates, it's going to raise the cost of borrowing. But that really isn't what we should be looking at when we're trying to understand inflation numbers, especially when the raising of interest rate costs have been so dramatic. This is something that should definitely be accounted for in the Bank of Canada's models and in anybody looking at the information provided to them. A lot of economists, if you look at the talk that's coming out of the Bank of Canada when they made their raise earlier this month in June, are expecting another 25 basis points coming up in July. And this just doesn't make any sense, because if you look at the statements coming out of the Bank of Canada, or you understand just basic common sense, is that when you raise interest rates, it takes close to a year for it to work its way through the system. So a very interesting stat is only 1/3 of all mortgages have seen an increase in their payments. So this increase in tightening hasn't even started to work its way through the system. And we have true inflation at 2.5%. And so the real concern here is that the Bank of Canada is about to get over ahead of its skis and over tighten and potentially put our economy into some type of duress. We don't need to be focusing on real estate prices, because that is not within their mandate. And in my opinion, and something we've talked about at length in this channel, that's a supply issue, and it shouldn't be thought about from a demand standpoint. So definitely lots going on here, but we really need to continue this pause and see how things play out as this tightening cycle still continues to work its way through the system. And we very much are seeing inflation continue to drop. It's down from 7 or 8% a year ago. We should be really happy with where we're at, and we should continue to see how things play out. But I think we're making a massive mistake right now here in Canada. And the other thing to keep in mind is that we always are watching what's happening to our big brother in the US. And they have a much different system where terms can go for 30 years, where we're sort of maxed out at 5 years. And so the impact in the US of interest rates hikes is very different from us and our experience in Canada, because everybody is 3 to 5 years, generally speaking, and a lot of people are on variables, where in the US, they're much less susceptible to an increase in rates. And I've heard economists talk about the equivalent of a Bank of Canada increase of 1% has the effect of 2% here in Canada versus 1% in the US. So definitely a lot to think about, but we definitely need to be rethinking our strategy here, and maybe even our system. And so with this latest increase, in terms of its effect on Toronto real estate and a potential another hike coming in the pipelines, we could start to see a bit of a shift in buyer sentiment. 2022, especially the back half of 2022, we saw a lot of buyers sitting on the sidelines as interest rates kept climbing. When the bank came out and said that they were going to pause at the beginning of the year, that certainty, because markets like certainty and people like certainty when they make business decisions or financial decisions, we saw a lot of buyers coming back to the market. We had a very strong spring market here in Toronto. Inventory, despite whatever the Bank of Canada does, continues to remain tight. We're at 30-year lows. So we could start to see a bit of a shift in buyer sentiment. And as we head into the summer, which is traditionally a slow time, I think we could expect to see a really slow summer in terms of transactions over the next couple of months. And what will be really interesting to see is if the Bank of Canada does in fact raise rates again, most of the buyers will have pre-approvals that are out there for 60, 90 or 120 days. So they won't directly be affected, and they may be even more incentivized to buy before the new rates would come into effect on the expiration of their pre-approvals. So I think we'll start to see potentially maybe a little bit more of a leveling off as we go into the fall. But again, I think the real issue is the potential larger economic damage that may happen as a result of these increases and as they continue to work through the system. And I wouldn't be surprised if we have a significant economic slowdown as the Bank of Canada starts to get too far ahead of its skis. and again makes another mistake, which we've seen happen at points throughout the last few years. With we're not even thinking about raising interest rates back in March 2020 to, well, yeah, there's inflation, but it's just supply chain, and then it's just transitory. While all the alarm bells were going off, and then they raised far too late, and then they've been doing it in a panic ever since, trying to catch up. And it seems like they continue to use lagging indicators or lagging information and are continually trying to play catch up to what is actually happening in the economy. And if they continue down this path, they are definitely going to put us into a recession, intentionally or not. But it looks like, if you look at the inflation numbers and understand their mandate, it could definitely be needlessly. Lots to unpack here, lots to think about, lots to watch as things play out over the summer. My name, again, it's Ralph Fox. And if you have any questions or comments, we'd absolutely love to hear from you down below. And please don't forget to smash that subscribe button.